That is the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blikre to get you up to speed on the action from today's trade. Let's see where the major averages ended up here. We have some green across the screen, it looks like, Jared. We have the Dow. Looks like we're going to finish up about 220 points. The S&P 500, your broad gauge, of about 0.3%. Tech-heavy Nasdaq also up about 0.3%. Jared, give us a closer look at today's sector action.
You bet, Josh. And let's just take a look at the intraday price action one more time, because we had some fireworks in the middle of the day here with respect to President Trump and some headlines on Powell. The bottom line is Powell's job is safe for now. Indices recovered and closing in the green. Dow up 231 points, as you just said. I think investors will take that. And let me just show you a quick run up on the bond market, because the 10-year yield and the 30-year also had some hiccups there, some interesting fireworks in the middle of the day. And you can see the 10-year ended down about 3 basis points. And guess what? The 30-year down almost break even, but still above 5.0%. So kind of a big deal there. And let's check out that sector action where we have most of the sectors everything except energy in the green today. Energy down about 0.9%. Healthcare in the lead. That's XLV over there, up 1.24%. Followed by real estate, and then financials, industrials, staples, all of those outperforming the S&P 500. And if we take a look at the Nasdaq, you're going to see more, well, it's kind of a balanced board here. NVIDIA up 0.4%. An hour ago when we were checking it, it was up just barely. Microsoft just barely in the red there. Meta down 1%, Amazon down 1.4%, and then Tesla up 3.5%. Kind of a mixed day in tech. If I show you the semiconductors, you're going to see a lot more red on the right part of the screen. The big guys, some of the big guys finish in the green there. I already covered AMD, but ASML down 8.33%. Want to check out the Dow as well, where we have some outperformance by J&J, up 6%. Also in healthcare, we got Amgen up 2%, Merck up 1% right there, and PG, that's Procter & Gamble, up about 0.2%. I'll round it out with the Dow Transports, and there we are seeing United Airlines. We're going to get some airlines news in just a few minutes. That's up 2.5% as of the close. JB Hunt up 1.7%, and the airlines, let's take a look at Southwest. That's up 0.7%, Josh.
All right. Thank you, Jared. Appreciate it. Chris, your thoughts, my friend, on today's action?
Another day at market chop, I think.
Mm-hmm.
You know, we're reacting to a lot of different things, right? Mm-hmm. We're seeing at the mouth of earnings, bank earnings we saw this morning, a little better than expected, but ASML pulls their guidance, just reminding us that we're at the mouth of the earnings season. Going to be a lot of resetting of expectations, some good, some bad. We want to make sure we're on the right side of that, Josh.
Tomorrow, we were talking off camera, one big name on your radar.
Taiwan Semiconductor.
Why is that on your radar, and what do you expect to hear?
Well, let's think about who this company is, right? They fab for NVIDIA, they fab for Qualcomm, they fab for Apple. So what they say is going to be very important about, you know, not only just the color on the June quarter, what was AI and data center, what was smartphone, PC, and the like, but their outlook for the back half of the year. This is the time when people start to, you know, really fine-tune expectations for the next 2 quarters. What they have to say is going to help reset those expectations. So to the extent that they give upside guidance, they come out and they say AI data center demand really strong. That's for some folks that will reaffirm the move that we've seen in NVIDIA. But I think that if they come out stronger than expected, and given what we heard yesterday on AI and data center from Trump in Pennsylvania and elsewhere, I think there's a very good chance that they lift that expectation, another leg up for NVIDIA and the rest of the AI chip trade.
Chris, always love having you on the show. Thank you for joining us, my friend.
Happy to do it.
All right, see you again soon. We continue following, meanwhile, the very public playout of what's next for the Federal Reserve Chair's career. President Trump saying he's not planning to fire Fed Chair Jerome Powell, despite new reports emerging suggesting he was close to making that decision. Let's bring in Ed Yardeni. He, of course, president of the Yardeni Research, sell-side consulting firm that provides global investment strategy and asset allocation analysis. Ed, it is great to see you. I think you know, Ed, where I was going to start today, and it was with those headlines, Ed, of Trump and Powell, reports that Trump was likely to fire Powell. Trump then saying no, he was not planning to fire Powell. I'm interested, Ed, longtime Fed watcher that you are, what you made of those headlines and what you made of the market response and reaction to those headlines.
It seems as though every single day now we have the White House beating up on the Fed in general, and of course on Fed Chair Jerome Powell in particular. It's a little strange because I think it's very unlikely that the president's going to fire Jerome Powell. The only thing I can think of is that the dollar kind of picked up the past day or so, and every time the president picks on Powell, the dollar goes down. So I think the president likes that aspect of challenging Powell. But it's all kind of bizarre simply because we know that Powell will be out as Fed chair next year in May. We know that the president is going to be able to pick another Fed chair, perhaps as obviously next year when the Powell is no longer Fed chair. And it's not clear why the president is so determined to get the Fed to lower the Fed funds rate from 4% to 1%. That's crazy. It doesn't make any sense whatsoever. The reality is the economy is doing just fine at this level of interest rates, and we should leave interest rates at these levels because when we actually need them in a crisis, when we need to lower them, that's what we want to save it for. So the main reason, obviously, that he wants to bring interest rates down is to refinance the debt at a much lower interest rate. But I think the reality is the politicians have to get their act together and narrow the gap between outlays and revenues. That's the only way. Lowering interest rates artificially is not going to do it.
You know, it's interesting. I was reading through some of the commentary today, and I saw some folks saying, they don't agree with Trump's approach, but they actually think Trump is right, that they should be cutting. And the argument kind of went like this, Ed, that in broad strokes they were saying, listen, to the extent that tariffs impact prices, it is going to be one time, right? It's going to be transitory. You're going to see it, and then it's going to ease and subside. And really, meanwhile, we're seeing growing weakness in the labor market. They should be cutting. What do you say to that?
Well, the Fed, by law, has a dual mandate. The dual mandate is to keep the unemployment rate down so we have full employment and to keep inflation subdued. And we're there. We're in nirvana. So why mess with that? Why lower interest rates when at this level of interest rates we've got a 4.1% unemployment rate? At this level of interest rates, we have inflation pretty close to 2%. It probably would have gotten closer if it wasn't for the tariffs. There could be, as you said, a one-time effect. I think what the tariffs have done is they haven't really boosted inflation so much as kept it from falling closer to 2%. So we're kind of stuck here at 3% maybe until the tariff effect wears off. So in effect, you're right. We should be getting close to 2% with full employment. Explain to me why we need to lower interest rates.
And so when your clients ask you how many cuts you would expect, what are you telling them?
I've been telling them none and done since the beginning of the year. I also told that to them early last year, and I was wrong about that. The Fed cut the Fed funds rate by 100 basis points late in the year, but we countered that don't be surprised if bond yields go up. And that's exactly what happened. The Fed lowered the Fed funds rate by 100 basis points, and the bond yield went up 100 basis points. And now on this news that turned out to be not correct, that Trump is set on firing Powell shortly. On that news, we did see the bond yield go up and the stock market go down. And so I think the market's telling the White House, beware of what you wish for and don't push your luck here. Just leave things alone. The Fed's doing a good job. The president should go out campaigning for Republicans so that they hold on to their thin majority next midterm elections. And he's got lots to campaign positively about. A lot has been achieved, and there's no reason to spoil it with this unnecessary attack on the Fed.
So now, Ed, the part of the interview where I ask you to take off the economist hat, put back on your strategist hat. I'm just curious, Ed, what you've made so far of this earnings season now that we've heard from the big banks.
So far, so good. Earnings, I think, are going to turn out to be resilient. I think they're going to be an easy beat. The analysts have lowered their expectations so that S&P 500 is expected to increase 3.5%. It'll probably increase twice as fast, maybe 7%. It did increase twice as fast during the first quarter. So we had a good solid beat in the first quarter, second quarter. And the reason this is happening is because the underlying economy is resilient.
Final question, Ed. What sectors right now do you want to stay overweight?
Well, I've been staying with the same ones. Information technology, communication services, industrials, and financials. They're very cyclical, and they've worked very well, and I would stay with them even though they have worked well and they have had tremendous rebounds here, and they're not cheap. But on the other hand, that's where the growth is.
Ed, always great to see and to have you on the show. Thanks for joining us.
Thank you.
Well, the U.S. dollar index taking a tumble in the first 6 months of the year, posting its worst first half performance in more than 50 years. But the dollar is not the only thing struggling as traders navigate a tricky adjustment period in the currency markets. Here to discuss all this and more, we've got Tim Baker, Deutsche Bank head of FX Research Americas. Tim, it is great to see you, to have you on set. Let me start with the story that was kind of dominating today, Tim. And that was reports Trump was likely to fire Powell, and then Trump says, no, I'm not planning to do that. But I'm just curious, how did those headlines, those reports, Tim, how did that play out for the dollar? And what did you make of the moves in response?
Well, I think the moves made quite a bit of sense, actually. The dollar fell heavily when Trump came out and denied it. The dollar came back a little bit, but still isn't back to where we were to start the day, particularly against alternative safe havens like euro and yen. So I think this is a kind of a continuation of what we've seen in the last few months, where there's elevated US political uncertainty, all this tariff uncertainty. The rest of the world has been very long US assets, and they've done very well out of it for 5 to 10 years now. But it's starting to rethink, do we really want this heavy exposure to the US in the presence of this uncertainty? Can we edge away and find something different? So I think we're increasingly getting, particularly the long-term investors, rethinking US exposure. So it makes sense that the dollar's falling around times like this.
We had, obviously, so weakness in the first half. We had folks on the show kind of suggesting that maybe we were bottoming here. Is that what you see? What's ahead?
Look, I've got sympathy with that view if it was all just tactical and there wasn't a big regime shift underway. If it was last year, the year before, hey, the dollar's down a lot and the US economy's not bad and it's not like the Fed needs to cut anytime soon. Look, that all makes sense, but I think we're in this regime shift because of it, well, not just because of this US political uncertainty, which is huge, but also what you're seeing elsewhere. Europe, FX is a relative game at the end of the day, right? We can be bearish the dollar, we need to be bullish something else. But this Europe story really has legs, we think. February, the German fiscal shock surprised everyone. And if there's one pushback back then, it was, well, the German fiscal stimulus, that's kind of 2026 onwards. Just a couple of weeks ago, we find they're bringing it forward to the second half of this year. So there's the euro kind of beleaguered, put to one side, really putting its hand up as an alternative safe haven. Now, nothing's going to challenge dollar primacy, but when the dollar's performed so strongly for so many years, it's been holding at these high valuations, and euro starts looking a bit more interesting, then it's easy to kind of sustainably kind of knock down the dollar a little bit.
So when you're making this call on the dollar, Tim, it's not as simple as just following interest rate differentials?
No, those were the easier days.
Yeah.
And that all works well in a kind of a normal environment, and valuations and positioning aren't extended. We already saw the dollar kind of overshoot, get expensive versus rates kind of late last year into January, and that was kind of like a positive risk premium. The dollar should trade expensive versus rates because who knows what Trump's going to do? He's going to put tariffs on this country and that country. Now it's turned out that actually hurts appetite for US assets, and now we're trading cheap versus the dollar. So that kind of makes sense. Rates still matter, but can you trade above what rates would suggest? Well, we did last year. And can you trade below like we are now if there are other factors? Yeah, absolutely. So it's a guide. We keep an eye on it. To the extent the Fed expectations change, the dollar changes on the day. But we think just this year, this big structural flow where global investors want to hedge more of their dollar assets, they want to reallocate somewhere else, that provides a kind of structural sell, I guess, of the dollar.
There was an interesting piece in Bloomberg, Tim, I don't know if you saw it, and they were kind of talking to different currency strategists. And the thesis of the piece was all about how maybe some of the tried and true signals those strategists would have traditionally relied on, depended on, aren't working like they used to and maybe misfiring. And I was just wondering, is that Does that dovetail with your experience?
Yeah, for sure. And that's what you get in big turning points. I mean, if I look at the dollar over the long run, tends to move up for 7 or 8 years, down for at least that long. We're at that turning point now. I think so. Different factors are going to work. Now, actually, the last month or so, rates have been working reasonably well across G10 FX. The biggest change in front end rates typically has led to the better performance of that currency just in the last month or so. But before that, it was things like valuation. The cheap currencies like yen were doing better. It was the net foreign asset position. Again, things like euro and yen were doing better. So I'd say it's really shifting regimes over the course of this year. I think we're going to return back to on that Q1 into April price action where valuations do matter, your net foreign asset position matters because investors really want to change their allocations. You know, these big, huge investment flows that have been so one way for the dollar for so long are starting to turn.
We started on Trump, we'll end here on Trump. What is your sense of, does President Trump, in your opinion, does he really want a strong dollar? Because he can send sort of mixed signals there. What's your sense?
Yeah, look, you're right, they're mixed. I guess President Trump has a lot of things he wants, and I just take him seriously on the stuff he talks about the most. You know, tariffs and bringing investment into America. That seems to be what he most frequently talks about, and I think he'll stay true to his word. Anything he's got to say on the dollar, we hear about it far less frequently for a year now, and then we hear mixed views on it. So I think it's way down the pecking order. It'll do what the market wants it to do. I think it's all about tariffs. I think you're serious there. And I think it's about bringing investment back to America. Now that's not entirely negative for the dollar if he can succeed in getting foreign companies to invest in America, even as foreign institutional investors want to pull back. Maybe there's a bit of an offset there. But generally, I think it's the portfolio flows that are going to be worse going out than those corporate flows coming in.
Tim, great to see you. Great to have you on set. Thanks for joining us. Appreciate it.
Thanks.
Well, it's been a big week for bank earnings, we know, and to put them into perspective, we're joined now by Anton Schutz, Menden Capital Senior Portfolio Manager. Schutz is the Menden Capital Senior Portfolio Manager. Anton, it is great to see you. Let's start kind of high level there, Anton. I'm just curious about the big themes so far you would pull out of these earnings reports. What have you learned about M&A, iBanking, the consumer? What's been your big takeaways?
Big takeaway is things are pretty good. Credit continues to behave incredibly well across the spectrum. So, everybody talking about banks failing when commercial real estate loans were due to reprice has been pretty wrong, right? We've had 0 banks fail because of commercial real estate. So first of all, let's get that one out of the way. In terms of margin, generally margin's going to end up rising for the industry. So we've got a mixed bag so far of who's reported, but thus far, I think earnings estimates actually go higher into 26 based upon all these reports. So that's good. M&A finally happened, right? We saw a decent sized deal, almost $2 billion. Huntington Bank bought Veritex a couple days ago. And, good transaction for everybody involved. Nice premium for the shareholders at Veritex. Full disclosure, my fund was a shareholder, has been a shareholder of Veritex for 10 years. So nice to see that come along, true capitalists. And we expect to see a lot more M&A coming forward. So, and also capital markets look good. I think investment pipelines are building for deals, IPOs, M&A activity across more than just financials. So, I think the health of the space is great. Valuations also look very, very good compared to any other sector of the S&P.
Anton, another big theme, investors in this space are watching, deregulation. What do you see ahead there? What's it going to mean for the industry? When's it going to show up in the financial results?
Well, it's already showing up for the perspective of, Huntington's deal is announced and they said they're going to close the deal in 3 months. That's unheard of in recent history. So I think that's really good news. We had deals out there that would languish for a year without ever getting an answer. So, really, really big change in terms of approvals. I think capital levels, again, are very, very robust in the industry. I think banks are going to be allowed to return more capital through dividends and buybacks. So again, more good news there. And I do think you'll see some bigger M&A deals come down. I think you'll see companies like Fifth Third and PNC potentially roll up some of the rest of the industry.
Let's get to some picks, Anton. Some of your top picks. FB Financial, ticker FBK. Why is that a buy?
Yeah, that's a company that's consistently delivered, right? They've done M&A, they've bought other companies, they've added to value. They've added to their attractive footprint in Tennessee, and they'll be moving into other attractive markets like the Carolinas and maybe Georgia. But really great management team, and they would actually benefit if there's other M&A that takes place in their markets, and there could certainly be more M&A that's disruptive in their markets, and they'll take advantage of that. So really like that management team. Strong capital, really strong reserve ratios, very conservative management team. So I think they're a builder of value since their IPO.
One more ticker while I have you, Anton. Equity Bank Shares, EQBK.
Another, buyer of other banks. They have 800 small banks in their footprint that they could buy. And they'll go to these small towns and they'll buy a 2-branch bank, and they'll pay the right price for their shareholders and the other bank shareholders. They'll create value, they'll clean up the bond portfolio, and they'll create some growth. So they've got a very good history of doing this. So either one of these companies could announce a deal at any point in time, and they're great at executing. And in a regulatory environment, they're closing deals quickly. Equity announced a deal, I believe, in February, and again, it's already closed. So, love management teams, love people who, get deals done, have great relations with the regulators, and have the ability to execute transactions that are good for their shareholders. And we're going to see plenty of other, upside coming from other banks actually getting taken over, and premium is being paid as well. There's a really big gap between the market cap of the mid-cap banks and the SMID and smaller. So the bigger banks get to pay really nice premiums. It's a win for all shareholders, including their own. And when that math happens, you've got an environment that's right? Regulation allows deals to happen. Average age of a board of directors is up to 66 years. It's up 6 years since 2018, right? Because deals just haven't had a chance to happen. I mean, think about the things we've had since 18, right? We had the pandemic, uncertainty. We had the Fed raising rates really quickly, caused some failures, uncertainty on the funding side. So again, how do you have M&A happen? You've had fear over recessions, uncertainty. It appears that things are starting to get a little more certain, right? That the tariffs are happening, the world's not falling apart, we've got economic growth, and I think we're really going to see a very good second half of the year for M&A, period. That's going to benefit everybody in the ecosystem.
Anton, great to see you, and thank you for your time in those picks, sir.
Great to see you as well.
More market domination overtime coming up. United Airlines reports its quarterly earnings. To find out if it's taken off, stick around. We'll have that and much more coming right up. United Airlines second quarter earnings just now crossing the wire, and joining us for more, we got Yahoo Finance Praz Subramanian. Praz, break down the report.
Yeah, I think there's a little bit of a little negativity here in the guidance, but let's start off with the top line numbers here. Operating revenue $15.2 billion versus $15.33 billion expected, so a miss there. But adjusted EPS $3.87 versus $3.84, so a beat there. But here we go, the guidance full year adjusted EPS of $9 to $11. They previously saw $11.50 to $13.50, so that's kind of coming down there. Current quarter, $2.25 to $2.75 adjusted EPS. That was previous $3.25 to $4.25. We're seeing something of a Newark impact, right, with those flights having cancellations and air traffic control issues. They're seeing an adjusted pre-tax margin hit in Q2 of 1.2 points because of Newark, and in Q3, 0.9% change there to adjusted margins there because of Newark. So, but they did say volumes are returning to normal there. So maybe there's a little bit of a upside in the second half of the year for United. But right now, stock down on 1.6%.
Yeah, it's interesting just looking at the comments from United CEO Scott Kirby. Praz talks about more proof that the United Next strategy is working. Does acknowledge what he characterizes as a volatile macroeconomic period. Says they saw a positive shift in demand beginning in early July, though. Like 2024, he says, anticipates another inflection in industry supply in mid-August. Ends by saying the world is less uncertain today than it was during the first 6 months of 25. Gives us confidence about a strong finish to the year.
Yeah, we saw that with Delta, same thing that Ed Bastian said, that saw a lot of positivity, the removal of the uncertainties of the tax bill, of more trade deals, making customers feel more optimistic about the future, and then they're buying travel. But it's funny, Kirby's saying these things about positivity, but they pulled down their guidance significantly. So I think that's sort of the mixed message here, and that's why we're seeing shares a little bit lighter here. Nothing crazy, but just a little bit lighter here. But Delta last week up 17%.
wild.
I mean, it was
What a
crazy.
pop.
So,
Yeah,
massive pop. So, tale of two cities here. United is a massive operator of the international space compared to Delta, so maybe that's why you see some lightness here because they're the big exposure from international, and we've seen that business, at least for non-U.S. travelers, come down somewhat.
Yeah, stock down about 2% right now. We'll see what they say in the conference call. Thank you, President. Appreciate it. Time now for what to watch Thursday, July 17th. We're going to start off on the earnings front. Some big names reporting tomorrow, including Taiwan Semiconductor, Pepsi, and Netflix. Netflix announced the results for the second quarter after the markets closed on Thursday. Analysts expecting another strong quarter for the streaming giant. See, the company is insulated from economic uncertainty and tariffs. Big titles powering the quarter include Squid Game Season 3 and Black Mirror Season 7. Taking a look at the consumer, U.S. retail sales data for June coming out on Thursday. Economists forecasting sales to edge up slightly to 0.1%. Be a rebound from May's drop, but signaling that consumers are still cautious about spending. And moving over to the Federal Reserve, we're going to be getting another round of commentary on Thursday from multiple Fed officials. This coming after comments from Treasury Secretary Scott Bessent to Bloomberg on Tuesday. Bessent suggesting that Fed Chair Jerome Powell should step down from the central bank's board when his term as chair is up in May of 2026. Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But they'll go anywhere. On the other side of the break, it's asking for a trend. Got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.